Well, we are entering the final few trading weeks of the year. Are we going to get this Santa Claus rally that everyone keeps talking about? Well, it's looking like, at least for this week, we are set for some upward momentum. There are two trades in particular that I have for you today that I think you're going to love. It's not the usual trades that you'll see. We're not talking about Palantir, Robinhood, SoFi. There are two stocks whose charts are primed for a big bounce this week. So come on into the charts and take a look at them with me. So my favorite chart for the week, number one, is Credo Technology. Look at how beautiful this chart is. We have everything still intact, which right now for a technology chart, that's pretty rare. We've got the 150 SMA, we've got the 50 SMA, we've got the 20, which is the middle of the Bollinger Band, all still intact. We have bounced off of this support here, which is held really well at around sort of that 130, give or take. And my favorite indicator, my favorite symbol to me that suggests let's look to enter is the stochastic RSI. We've got this beautiful turn on a nice green day. What's the play for this week? Well, for me, I actually started this trade last week. So I bought 100 shares at around about $149. And my plan is to ride this up probably to see if we can get back up to that 190 mark. Now, I will just play this by ear and see what the week brings. But my expectation is that we can get at least up to sort of this level here, which is around about that sort of call it 170, 175. When we get there, I will then make the decision of, am I going to sell a covered call? Am I just going to sell the shares outright? But that's my play for the week, is that I'm anticipating that we're going to get back up to around about this level. Now, if you want an options play for the week, this is what I would do. The 130 has proven to be amazing support. And from here, the expectation isn't that we'll just sort of side to side or drift back down. The expectation is that we're going to, drift higher. So here's what I feel most people get wrong when it comes to options. The traditional play over here on options strat is that we sell a zero point 0.2 delta around about 4 weeks out. So that would be around about the 130 at January 16 for a $480 credit. Good. There is nothing wrong with that. But the play that I like better for my cash secured puts is to go out further. So if we look at February, we've got a credit of 1,055. Now, we don't have a March or an April. May might be pushing it. I mean, we could get a credit of over 2,000, but we are going out a bit further. Now, I still intend, this is important, I still intend to exit this trade earlier if I take it. But here's the key. January 16, if we hold this all the way to expiration, the most we can make is 480. Okay. If though I opt for the February 20, let's remember I said, coming back to the chart, I expect that we're going to get even to sort of this 170 level. Okay. If I take the February 20 and we can get to this 170 level, call it 176 by January, let's go to the same date, January 16, which would be about here, I stand to make $825. So I can exit this trade the same date for more profit. And this is how I compound my earnings faster over and over and over again. I don't wait to expiration. I sell the longer dated put, but I always sell it with the expectation that we're going to get that bounce in the market. So that's my number one trade for this week, Credo Technology. My next is our friend Google. And I like Google for the same reasons. One of the few tech companies to have all of their moving averages intact, to still be a healthy uptrending chart, to still have higher lows, higher highs, right? We're still in that bullish upwards trend. Now, the play for this week, I actually already have a put credit spread on. I put that on, I think I put that on this date, just as a quick little $1,000. Let's get that bounce. Let's get some quick cash flowing. The stochastic RSI tells me that we are likely to bounce probably back to these same levels, around that sort of 320, call it. Now, with this one, I actually don't want to buy the shares outright because I don't want to tie up $30,000 worth of capital in Google. So what am I going to do? I'm going to go for the cash secured put. Now, you may be saying, well, hold on a minute, cash secured put, you're still tying up $30,000. Yes, but when I sell puts, I like to use margin for that. So I'm technically tying up less money. Now let's do the same scenario, right? If we were to go out to January 16 and select, typically I would say, I'm going to go for around this sort of 290 mark. Now, most people buy or sell options based off of delta. I personally, when I get this setup of, right, the stochastic's turning, we're coming out of this slight downtrend, the expectation is that we bounce. I'm playing for the bounce. So I'm happy to be a bit more aggressive with my trades, and I don't look at the delta. I just look at what's the area of support. And I think we've got some really nice support here around that 290. Now, again, if we come to the 290, and if we're looking at January 16, 304, that's a small percentage, right? And remember, my expectation is that we're getting back here to the 320 level. So if I'm looking at around this 320 level, what can I get in terms of premium if I just simply sell an option further dated? So February, and again, if I'm looking that the expectation is to exit by the 16th at about around 320, well, you can see here the 320, if that's where we're at on January 17, all other things considered equal, then we can exit for about 622. Better. What if we go to March 320, January 16, around about 598. So you can see that there's this beautiful balance between how far out we go in strike versus how high we have to go. Now, of course, if we go for the March 20 and we overshoot that $320 price and we just continue to skyrocket back up to all-time highs, then absolutely this one makes sense. But I actually think I prefer the February 20 at this point, because I think around this sort of 320, 325 is a realistic price point. And if we go higher, amazing. But I stand to make an awful lot more money. So come Monday, this is a play that I'll be looking for. I'm not in this one yet. I am in Credo. But this is the way that I like to play options. I always play for, let's not try to guess where the bottom is, especially coming back and looking at Credo technology. So many people were selling their options on the way down. And typically the advice is, we get a red day after a good move up, we get a red day or 2 red days, then we sell at the middle of the Bollinger Band or we sell a 0.2 delta. But the problem with that is that you're in a backwards moving trade right from the start. The better option, find the bottom, wait for at least the short-term bottom to come in, get that turn on the stochastic. We could tell reasonably, with a reasonable certainty, that we were going to continue the ride down here. Why? Because the stochastic hadn't flipped. The stochastic is now flipped. This is a trade I want to take. I took it here. It was around this day. The stochastic flipped. We rode up. Same over here. Stochastic flipped. We rode it up. So this is my number one indicator for when you want quick trades with the most amount of certainty, as much as we can get in the market, and with plenty of upside. So that's my trade for the week. Let me know if you take either of them, and I will keep you updated with how these go.